manufacturing accounts. And in this module, we will learn about the formats of financial statements which we use in manufacturing entity. So please be attentive. These are little different because of the manufacturing account, but you will find it very much easy to understand. So over here, this is a format of a manufacturing account. We are just taking it a sample company. Title is manufacturing account, and this is prepared for the year ended 31st December 2009. It is our assumption. So again, these columns are, first two columns are for working, and this is the final column. And we see that direct material consumed is the first information that we need to work out, for which we have an opening inventory we will place over here. Purchase of raw material will be adjusted with raw material return, means returns outward, or purchases return figure, which will be subtracted. Then carriage inwards and other receiving and handling cost of material will be included in this cost of purchase. Okay, which will be then taken to the other column where we will add opening inventory of raw material purchased or direct material, and then we will subtract closing inventory in this column, so that we are having direct material consumed figure over here. Okay, so that's why we used here direct material consumed. Next comes direct labor cost. So it is straightforward the cost that we will put over here under this direct material consumed figure. So direct material consumed plus direct labor cost, and if there is any other direct cost, we will place it over here. In normal questions, you will not find this other direct cost, but just because we are discussing a format, just to make it more comprehensive, we are discussing that this direct cost, if any, other than this direct material consumed and direct labor cost, if there is any other direct cost, that will be placed over here, so that we are having prime cost with us. Okay, so the combination of these direct costs is known as prime cost. Well, the prime cost which we will be having in the outer column will now be added up in factory overhead cost, so that we have total factory cost with us. Okay, so we need to work out factory overhead cost. This is also known as factory or production overhead cost. Okay, so this factory overhead cost or production overhead cost is then worked out by adding indirect material, indirect labor, power and fuel, factory related depreciation. This can include depreciation of plant and machinery or depreciation of factory building. Okay, or any other indirect cost or other factory related expenses. Okay, so these will be grouped in the inner column. Their sum will be taken in the outer column and will be added up in the prime cost, so that we are having total factory cost or total manufacturing cost or total production cost. We can give any name to this figure. This is the figure. Okay, well, now we are done with all the cost things. We have accumulated all these costs: direct material cost, direct labor cost, other direct cost means the prime cost, and the factory overhead cost. We are with this total factory cost now. So we will adjust this total factory cost, which is in the workshop physically, if we will see. So just visualize a workshop where we have put all these costs. In that workshop, there is opening work in process inventory at the beginning of the year. Add this into it, and then subtract closing work in process inventory. You will get cost of goods manufactured. Okay, so this cost of goods manufactured is in fact the outcome of manufacturing account. here manufacturing account ends. Well, next comes trading account of a manufacturing entity. Well, this trading account, obviously we are now selling our product that we produced during the year. So we are selling this product means there should be cost of goods sold. You can also phrase it as cost of finished goods sold, or manufactured goods sold, or produced goods sold. Okay, so your concepts should be very much clear that what we are preparing. Not simply you are cramming the things, just your concepts should be built up. Well, so the sales figure, the gross sales figure, will be adjusted with the sales return, which is also known as returns inward. And then we will have net sales. This is something we have already practiced in other organizations' income statement, which were the trading entities. Okay, so the same sales, you can see that the formula is almost the same: opening inventory plus purchases minus closing inventory. This was something we used to do in trading entities. So opening inventory is now opening finished goods inventory, purchases is now cost of goods manufactured, and closing inventory is now closing finished goods inventory. So this working we will do, and ultimately we'll get cost of goods sold figure here, which will be subtracted from the sales amount, and we will get gross profit. Okay, so this is the outcome of trading account. The cost of goods manufactured was the outcome of manufacturing account. Gross profit is the outcome of trading account. Okay, so the important tips to remember in this module are that manufacturing account is integral part of the income statement. We did not discuss the format of the rest of the income statement, in which operating expenses are presented and other income is presented to get net profit. Okay, we just discussed those two parts, means the manufacturing account and trading account, which are new for these manufacturing entities. Okay, so manufacturing account is an integral part of the income statement now. Okay, the next thing is manufacturing account provides information for the trading account, which we will be using in the trading account, and trading account provides information that we will be using in the profit and loss account. Okay, so these were the few important tips to remember. Thank you.